I do appreciate the chance to speak here. I've been doing this for a number of years. First of all, I have an immense respect for all of y'all and what you do, and what y'all do is obviously very important. I'm a bond lawyer or a public finance lawyer. So is Jennifer here, who joined my firm last year to work with me at Gray Robinson. We're in the Tampa office, but we practice all throughout the state, representing counties and cities and various governmental institutions in connection with the issuance of bonds and doing debt financing. Our goal here is it's a very basic presentation that we kind of build up on to kind of explain what bonds are and what you as an elected official need to know about bonds and debt financing, because as we'll get to at the end, you do have both the Securities Exchange Commission and the Internal Revenue Service that also take an interest in what you do with debt financing. And the goal is to educate you a little bit to the extent you're not familiar with the stuff, just so you know what to look out for, protect yourselves, and protect, obviously, your constituents. At any point along the way, please feel free to raise your hand and ask any questions, and we'll stop. I think I'm going to talk for a little bit, let Jennifer talk for a little bit, and then I'll probably finish up so that you're not listening to the same person drone on for the last hour of a Friday, which I know isn't a lot of fun. Jennifer has been practicing for quite a while. As I mentioned, joined me last year. Like myself, she's been in Florida for a long time and went to schools here, and is an experienced public finance lawyer as well. Starting off at the most basic, when we talk about bonds, we're talking about any other type of borrowed money. It's just simply a promissory note where you agree to pay back what you borrowed plus some percentage of interest by a certain date. So when people talk about bonds, they're not talking about anything different than promissory notes or any other type of borrowing that, that you would talk about. A lot of time I might talk about municipal bonds. In the industry, municipal bonds doesn't just mean municipalities, it also means counties, and typically is used to reference any other type of borrowing by a governmental entity or the type of entity that will issue tax-exempt bonds, as your counties will. Some examples of promissory notes, obviously, are and which are trying to show similar to bonds and how they work, would be mortgage loans, car loans, installment loans, corporate bonds, U.S. Treasury bonds, and municipal bonds. Basically, they all work the same. The one feature that's different with a municipal bond, or if your county goes to issue bonds, is unlike your mortgage, which you pay typically principal and interest back once a month, and the same with the other types of loans. With municipal bonds, you're going to pay back principal once a year most of the time, and you're going to pay interest payments twice a year. And you're going to do this over, depending on the length of the bond, up to 30 years or more. So tax-exempt bonds, they're a little different than the other types of loans, not just in the fact that we repay them slightly different. Whereas the lenders of money will pay income tax on the interest that is earned from the various types of loans, mortgage loans, car loans, installment loans. With municipal bonds or bonds issued by the county, the lenders will loan money at a lower rate to you because they don't, assuming certain requirements are met, have to pay income tax on the interest that they earn. So it makes it, in that way, an attractive investment to offset the lower interest rate. Hold on, I'm getting the hang of this still. So first, I guess a couple points are, just because you're a county and you issue a bond doesn't make them tax exempt. There's a couple of requirements that need to be met. First of all, you end up hiring professionals like us or other bond attorneys to represent you, and you have to get an opinion from the attorney involved saying that this is a tax-exempt bond. And in order to do that, the bond counsel is going to look at why you're borrowing the money, what you're borrowing it for, what you plan on spending it on, and for some, if you're refinancing a bond that you've already issued at a lower rate, you've typically already spent the money and gone through this analysis before, but it still has some restrictions. If you are a new project, there's restrictions in order to be tax exempt that you're not giving the money in turn to private companies to spur development. There's limitations on that as well. Typically for county projects, the private use aspect of the project that you're financing will have to be kept to about 5% of the proceeds. And through the 1986 Tax Reform Act, we have a lot of other requirements. Notably, one of the things is that you can't arbitrage the money. As much as you would like to borrow money at the lower rate, since you're getting a lower rate for issuing tax-exempt bonds, you can't borrow the money at 2% and turn around and put it in a bank and earn 5% or some other investment to earn a higher percentage. So there's a lot that's called arbitraging. There's a lot of restrictions against that. We also, before you issue bonds, and your attorney will issue his tax-exempt opinion, you have to have a reasonable expectation that you're going to spend the proceeds within a set period of time. Typically, you need to have, within the first 6 months of receiving the bonds, you need to have an obligation to spend 5% of it on capital expenditures, and you need to expend 85% of it within the first 3 years. So these restrictions, again, are so that you're not borrowing money and turning around and earning more off of it. And the reason that counties and states that you're able to issue tax-exempt bonds is a long history between the state and federal government. In 1895, there was a Supreme Court decision that basically said that the federal government couldn't impose taxes on municipalities for the interest income earned. So it really comes down to a state-federal debate over whether or not the federal government has this power. There has since been a Supreme Court case in 1988 that said that they can tax, but at that point it had already been codified in the Internal Revenue Code that you have the exemption. So like all other types of loans that we've talked about, lenders don't hand you over a bunch of money and obviously tell you to go spend it how you want to spend it. They have a security for it. Obviously, with mortgage notes, if you don't pay your mortgage, your real estate gets foreclosed. Car loans, they take your car back. And with municipal bonds, it's normally a pledge of a revenue stream. There are all different types of ways to secure bonds that are issued. And I'm going to hand it over to Jennifer in a second to let her start going through some of the revenue streams. And there was, as you know, the ability to pledge your taxing power or general obligation bonds, which Jennifer will explain involves a vote of the electorate, which means that they're very, very rarely done because voters tend not to obviously approve to raise their taxes. So we always look for a particular revenue stream to allow you to fund different types of projects. So with that, I'm going to let Jennifer talk for a few minutes here. And
hi everyone, Jennifer LaRocco with Roy Robinson. Let me add my thanks to Brian, to you all for giving us your attention on this Friday afternoon on the fascinating topic of bond finance. As Brian said, anytime you're borrowing money, you have to figure out how exactly you're going to go about paying it back. And likewise, bondholders, like any other lender, want to be sure that they have security for the money that they're lending you. And the most common way that we see this with bonds is through the pledge of a revenue stream. We've got a chart up there of some typical projects that are often financed by bonds, and in the accompanying column, some typical revenue streams that are pledged for those type of projects. Before we get into the revenue streams, I just want to talk for a minute about what it means when we say pledge a revenue stream. It means that you're giving bondholders a lien on that revenue stream so that if you don't pay, they can go to court and claim those revenue streams. The flip side of that is that in most types of bonds, that revenue stream that you pledge is going to be the bondholder's only security. So it's not with the exception of general obligation bonds, which we'll talk about in a minute, most bonds are not secured by an overall full faith and credit pledge from the county. And therefore, we call these revenue bonds because they're secured by a specific revenue stream. So, like I said, we've got on the chart, we've got some typical revenue streams there. Usually, the revenue stream that you pledge for a project is going to bear some relation to the project. So, for instance, if you're building a water treatment plant, it would be very common to see water and sewer revenues pledged for it. you're probably not going to be pledging fuel taxes for that type of project. You do also have some more general revenue streams like sales taxes that we see pledged for some wider ranging type of projects. When you're deciding which revenue stream you would want to pledge for a particular bond issue, you need to be mindful of certain limitations. The first one is statutory. A lot of these revenue streams have statutory limitations imposed by the state legislature as to how those revenues can be used. For instance, most fuel taxes can only be used on transportation projects or projects closely related to transportation. So for instance, if you're putting in a new school, you're probably not going to be able to pay for that out of fuel taxes. Your second limitation is local ordinances. Very often with some of these discretionary types of revenues like discretionary sales surtax, you may have an ordinance that levies that tax but promises to use a portion of it for a fire department or for the police, and that would be specific to your city or county. So you need to check the local ordinance that you have in place to make sure that you can in fact pledge those revenues for the type of project that you have in mind. And the last place to look for limitations is if you have prior debt outstanding that has already pledged those revenues for that prior debt. There's probably going to be limitations on how much future debt you can issue pledging those same revenues. So those are some things to keep in mind when you're thinking about where you're going to look to pay back your debt. We're not going to spend a whole lot of time going through each and every one of these revenues. I understand that Ginger talked to you all earlier today about some of the legislative updates to these revenue streams. So the last thing we want to do to you on a Friday afternoon is repeat information that you've already heard. But there are a few on here that we want to highlight just a little bit. The first one, Municipal Services Taxing Unit, Municipal Services Benefit Unit. These are two options that are available when you're looking for revenue streams for projects that are typically targeted for a specific community or specific need, like sidewalks or lighting are common examples for that. In the Municipal Services Taxing Unit, as the name implies, it's a special district that's set up that levies a tax on the properties that are going to be affected. It's an ad valorem tax that shows up on the tax bill for those specific properties in that community. Municipal Services Benefit Unit, same concept, except instead of an ad valorem tax, you're levying a special assessment. But in either case, what you do is you pledge to bondholders that the revenue that you get from either that ad valorem tax or that special assessment will be pledged to pay back the bonds that you've issued. You also have regular special assessments, not necessarily through an MSBU, that can be levied for road projects. Again, with special assessments, you've got two requirements that you have to meet. The first is that, well, first of all, it's worth noting that a special assessment is not a tax. So if you've got folks that don't like taxes, a special assessment is one way to raise money without technically raising taxes. You've got two requirements that you've got to meet. The first is that the project that you're undertaking has to confer a special benefit on the properties that are being assessed, which has to be something more than what the public at large receives. So, for instance, if you're putting in a road project, you want to make sure that you probably can't assess all the properties within your city or your county if you're doing just the roads in a particular community. And the second requirement that you have to meet with special assessments is that they must be fairly apportioned among the benefited properties. There's a lot of different ways to get there. Depends on the type of project that you're looking at. You might be looking at road frontage, you might be looking at what type of property you have, whether it's residential or commercial, single family, multifamily. And there's, like I say, there's a lot of ways to get there, but you just have to meet that test. We also see special assessments with community development district bonds and other types of dependent districts. But in any event, same concept. You're pledging the revenues that you get from the special assessment to the bondholders to pay back the bonds. Another type of revenue stream, which is actually not on this chart that we wanted to mention, tax increment financing. This is if you have an area that's blighted. We see this very often with community redevelopment agencies. And what you do is you say, we've got our tax base at a certain rate, in the blighted area. Now we're going to do our capital improvement project that's funded with bond proceeds. Hopefully, our tax base is going to go up, and we're going to receive more in ad valorem taxes, and we're pledging that increment, that increase that results from the project, to pay back the bondholders. So that's a general overview of some basic types of revenue streams that might be pledged. So basically, your hallmarks there, revenue bonds, are you have a specific revenue stream that's being pledged that is the sole recourse for those bondholders. We've got another revenue stream on here that we want to talk about that functions a little differently, that's under general fund non-ad valorem revenues. This is what we call a covenant to budget and appropriate deal, or CB&A. We're lawyers, so we have abbreviations for everything, and plus we use these terms a lot, so we get tired of saying covenant to budget and appropriate all the time, hence CB&A. This is a useful mechanism that works a little bit differently. It's not a pledge. Rather, it's a promise to repay debt out of non-ad valorem revenues. So you're covering a wider spectrum of revenues that you might be pulling from, and bondholders don't have any specific lien on any specific revenues. They really just have your promise to budget and appropriate. Again, it's non-ad valorem revenues, so you cannot use ad valorem property taxes to pay back this debt. But anything else is fair game, subject again to certain limitations. We all know that you had this great balanced budget game. You need to balance your budget. So a covenant to budget and appropriate can't force you to have an unbalanced budget. It cannot prevent you from budgeting for the general health, safety, and welfare of your citizens. So if paying debt service means that you're not going to have fire department or police department, the covenant can't force you to not have those services. And again, with CB&A, like specific revenue streams, are also subject to those same statutory, local ordinance, and prior debt pledges, so that if, for instance, you have previously pledged your fuel taxes specifically under a specific fuel tax bond, that pledge is going to take priority over any budgeting that you do under a CB&A deal. So the one other option that we may see that's become a little more common after the Great Recession is we're seeing specific revenue streams that are being pledged with a CB&A backstop, which is a way to give bondholders a little bit more comfort if your revenue stream maybe isn't as strong as you might like it to be, or as bondholders might like to see it. So you promise, look, if our water and sewer revenues aren't enough to pay for our water treatment plant, we'll covenant to budget and appropriate out of our non-ad valorem revenues to make up the difference. Choosing the right revenue stream is obviously a very important decision to make as you're thinking about issuing bonds. It's going to impact how easy it is to meet your debt service requirements. It's going to impact your ability to issue future debt that may be payable from some of these revenue streams, and depending on how strong of a credit that revenue stream is, it's going to impact the rating that your bonds get, which in turn will impact the interest rate that you pay, which of course is at the bottom line what really matters, because you want to keep your interest rate on these as low as possible. All right, now we can watch me break the technology. Ooh, I went in the right direction. Good, because I didn't want to have to talk about that slide again. Okay. So earlier I mentioned general obligation bonds. These are bonds where you are pledging the full faith and credit of your city or your county. It's not a specific revenue pledge. This is, I'm going to pay it back no matter what. That means it comes along with the taxing power. That means that if you don't have enough revenues to pay back the bonds, you have to levy ad valorem taxes on the property owners to raise the revenues to pay back the taxes, or to pay back the debt service. Since voters are potentially on the hook to get taxed for these things, it's really only fair. The Florida Constitution requires that any general obligation bonds that mature more than 12 months after issuance have to be subject to a voter referendum and voter approval. Another one. Voters don't like taxes, in case you didn't know. So we typically don't see general obligation bonds come up very often. We may do maybe one a year out of all of the many transactions that we do, if that. But typically, a very common alternative to this is the CB&A. It's a way to get there without putting your taxing power on the line, and investors are pretty used to the CB&A as well. Okay. Why do all this? Well, it's so much fun to talk about, clearly, but in case we want something a little more tangible, this chart is giving you the benefits, pros and cons of bonding versus not bonding. The first column, pay as you go, is basically the concept of we're not going to do anything, we're not going to commence any projects until we actually have the money for the project in the bank. The downside to that, well, there's a couple. It means that you can't actually construct the project until you have the money in the bank, so you may have to wait a long time to build the new school or build the new road or the new fire station or whatever project you have in mind. It also means that the people who are using that project today are going to bear the entire cost. So even though you have a facility that you're building that may be around for 30 years, you're putting all of the cost on today's citizens to fund. And the last one, their project costs escalate over time. Prices do tend to go up, so if you're waiting 5 years to start a project, as you bank the money, you may wind up with inflation increasing the costs. Of course, the positive to this is you don't pay interest because you're not borrowing any money. The pay-as-you-use side, which is the bonding side, is sort of the mirror image of that. What you've got the pros and cons sort of switching. You can start the project right away. As soon as you issue the bonds, you'll have the money to build. You're spreading out the cost over time, so that new water treatment plant that you're building, the bond debt service is going to be paid back. Typically, bonds are paid over about 30 years. So you'll have the user fees that are generated over 30 years paying for that water treatment plant, rather than everyone currently in day one having to fund it. You can construct more rapidly, and you can also construct at today's project costs, and you're not running the risk of inflation. Downside, interest, because again, it is money that you're borrowing. Oh, now I'm going to have to click through each one of these bullets. Who put together this PowerPoint? Not me. Anyway, so let's assume that let's assume that you've gone through the pros and cons and you've decided, okay, I'm going to go ahead and bond. Who's the cast of characters that you're going to wind up working with? Well, the first one is the issuer. That's you. That one's pretty simple. Issuer's counsel. That may be your in-house city or county attorney. It may be outsourced to a local firm. But this is the person that sort of looks over your shoulder and makes sure that the folks that are signing the documents are the ones that are properly authorized, all that good stuff. Your financial advisor, just what the name implies. These are folks that will advise you as to the structure of the deal, timing, revenue source. To go back to the first slide that I talked to you about, bond counsel. These are the folks that actually prepare the bonds, including your bond resolution. They're the ones that create the fancy green paper that get signed, that are the actual bonds. And the most important thing that the bond counsel does is they are the ones that will render the opinion that the bonds are tax exempt. This is the crucial piece for investors who want to make sure that they're getting that tax exemption. Disclosure counsel is someone you may or may not have. As governmental issuers, you're exempt from most of the securities laws, but bonds are still securities, so they're subject to some of the laws, most important of which is that you cannot make materially misleading or false statements in any document relating to the offering of the bonds. If you do, the SEC comes after you. That's bad. So anytime that you are going to try to access the public markets, sell to investors as a whole, you're going to need an offering document. It's disclosure counsel's role to make sure that the SEC doesn't come after you for any of the statements that go into that offering document. We're seeing now an alternative is very often, not very often, but a portion of bonds nowadays are getting privately placed with banks. If you do that, you may not have an offering document and you may not have disclosure counsel because you're not putting that prospectus out there. This next series, which I'll go through all at once, the underwriter. The underwriter is the entity that buys the bonds and from you and remarkets them. So they're basically the broker for your bonds. It's important to remember when dealing with underwriters, they can be very helpful along with your financial advisor. They can give you the inside line on what investors are looking for in terms of types of credit they like to see, what kind of interest rates you might expect to pay. But remember that your underwriter is not really your underwriter. They're working on their own behalf, and you may have different interests from the underwriter. We've got a couple of different terms up there. If you're doing a fairly small deal, you'll probably only have one underwriter. If you get into large, you know, 20, 50, $100 million projects, you may wind up with a senior underwriter who's basically going to run the show, and then various other underwriters, they get together as a group to buy the bonds. Then some other parties up here that you may or may not see depending on the structure of your deal. Oh, I'm on TV. The first one there is a trustee. If you have a typical straight-up government deal, say a utility financing or something like that, you're probably not going to have a trustee. If you get into more complex deals where conduit deals where you might be issuing bonds and then loaning the money to, say, a nonprofit, university or hospital, something like that, you'll often have a trustee that holds the funds. Trustees council is obviously just that. A consulting engineer, if you have projects, for instance, utility projects, road projects, where you need an engineer's report to give you the cost or scope of the project, you'll have a consulting engineer. The revenue consultant, typically seen in deals where your revenue stream is a fee. So if you've got toll roads, for instance, or airports where you're going to have passenger facilities fees, things like that, the revenue consultant will basically tell you how much you need to charge in fees in order to pay your debt service, which is always a handy thing to know. Bond stuff you'll hear about. I don't know why the stuff is in quotes, but anyway. The first one actually that's not on the list, but that I want to mention, you're always going to have a basic bond document. It depends on the structure of your deal, but it's typically going to be either a resolution or an ordinance, or again, in a slightly more complex deal, you might have a trust indenture. But whatever form it takes, this is going to be your contract with bondholders. This is going to be the thing that lays out the security, what revenue stream. It's going to lay out various covenants that go along with the bonds, and all your various obligations and the bondholders' rights. The next thing, flow of funds, really just what it sounds like. And if you've got a revenue bond where you've pledged a revenue stream, bondholders want to know what's going to happen to those revenues as they come in. Typically, you'll see things like we call them buckets or waterfalls. Picture the revenues coming in and sort of flowing downhill and hitting buckets as they go. This is going to vary by deal, but you might have first funds going towards operating and maintenance expenses. If you've got a toll road, you want to make sure that the toll road keeps functioning so that the tolls keep coming in. That works to everybody's benefit. Then the various buckets of debt service, principal, interest, and your reserve accounts that need to be met. And eventually, typically, hopefully, there's enough money at the end of the flow of funds that there's revenues left over to be used for other purposes as well. Debt service coverage. This is the ratio of the amount of revenues coming in to the amount of debt service. Obviously, bondholders want to know that you've got enough coming in to cover what needs to be going out in terms of debt service. So you'll typically have a debt service coverage ratio that you have to maintain, which is set out in the bond documents. It could be, say, 1.5%, whatever, or 1.5, whatever the bond documents will provide for. Rate covenant, again, you're covenanting to the bondholders that you're going to charge enough money, whether it's tolls or utilities, fees, user fees, whatever your revenue source is, that you're going to charge enough to make sure that you can cover the debt service. Additional bonds test. We talked earlier about if you have existing debt that already pledges a revenue stream to that prior debt, if you want to issue further debt out of that revenue stream, bondholders want to make sure that you're not overextending yourself. So before you can issue additional bonds secured by that debt, you're going to have to meet an add bonds test, as we call it, because additional is a really long word and we say it a lot, so we abbreviate. But anyway, you'll also hear the term parity debt, which is part of this. It means that all that debt that's secured from that revenue stream is on parity with itself. So if you have Series 1, Series 2, Series 3 issued over, say, 5 years, all of those bonds are going to be paid equally. So it's important for you to understand that it's not like a typical lien where whatever got issued first has priority. If it's issued on parity under the same master bond document, it's going to be payable on parity. A debt service reserve fund, you can think of this as a rainy day fund. It's a pot of money that you have to set aside that will sit there and be used only in the event that you don't have enough revenues from other sources to pay your debt service. It can be funded with cash, in other words with proceeds from the current bond issue, or there are also insurance products that you can buy where you pay a premium out of bond proceeds and then you place that insurance product in the reserve, and that covers you. It's typically some percentage of the debt, either 10% of the debt, or more commonly it'll be your maximum annual debt service that you'd have to pay over so the most you'd have to pay in principal and interest in a year over the life of the bonds, or an average of what you'd have to pay over the life of the bonds. There's a couple of different ways to do it. And which way you go is going to be something that you determine with the financial advisor and the underwriter as you go to price the bonds. It's really dictated by what the market looks for. Depending on the strength of your credit, you may be able to set a reserve account requirement of 0. We're seeing that not infrequently. Bond covenants. These are promises of things that you will and you won't do as long as the bonds are outstanding. These are just some examples. For instance, if you've got utility bonds, you're going to covenant most likely that you're not going to give away free utilities. You're not going to sell the land that the project sits on, things like that. All right. Well, I see that you are all riveted, so I'm going to turn you back over to Brian, who's going to be even more riveting.
The good news is we're on the home stretch here, so. Basically talking about the timetable of what goes on in a bond transaction. It starts with y'all guys a lot of times. You make a decision that you want to do an exciting project, or you want to refinance for lower rates. Normally it's your senior staff and talking with your financial advisor that realizes that the rates have come down and now's a good time to enter the market. The big stuff, the stuff that we all like working on, new stadiums, and of course water, sewer pipes, and projects, roads, that normally comes from the top, from y'all guys. The next step on a new project is that we do a financial or a feasibility analysis, and a lot of them, and this is where you're hiring professionals to come in and to see if this really makes sense. Kind of like your financial advisor looking at your background and whether or not you can sustain what you want to do. Then the real excitement starts, at least for us. I'm kidding there. The drafting the documents. As you can imagine, when you go to buy a house, how many documents are involved? When you go to finance a sports stadium or a water or sewer plant, quite a bit of that involved. The next step, a lot of times with counties, is before we even get to the pricing. Is a lot of times we go to the rating agencies. There's Moody's, S&P, and Fitch, the names that you're familiar with probably, which will give a ratings on your bonds, which will affect the pricing of your bonds. Not surprisingly, those of y'all that balanced your budget first in this game earlier were probably are going to get a better rate than those that were struggling at the very end and moving stuff around like crazy to make the budget work. The pricing actually, and I'll talk a little more about it in a minute, but that's the day that they set the repayment terms of your bonds, working through the various people that Jennifer discussed in the working group. The pricing is actually a bond purchase agreement is the document of all the documents that are signed. There's actually a purchase agreement where the terms of the bonds are outlined between the underwriter and the county, setting forth the interest rate, the repayment period, the par amount, how much you're borrowing. Then you get to the closing. It will be the word you hear a lot, and that's when the mayor or the county commissioner or whoever's signing the various documents to bond the authority. Sometimes with bigger counties, it can be a member of the senior staff. They sign and the transaction actually closes. This whole process can go as quickly as a couple of months on a refinancing of a smaller, straightforward project to controversial projects that can extend over a couple of year time. Sometimes you start a project, you fail, and you come back and you've aged quite a bit since it started. Then I want to talk a little bit about how we sell the bonds. There's essentially two ways. We have competitive bids and we have negotiated bids. Negotiated are the much more common. The competitive underwriting is you work with your financial advisor and your lawyers, and you actually pick a day that you're going to go to the market. You put your offer of how you're going to sell the bonds, the key terms and so forth, your offering document that explains all the terms of the bonds and the risk involved. And the underwriters all submit bids. And typically you go to the one that provides you the lowest interest cost to borrow. You really have to know what you're doing in these transactions. You need to have a very experienced financial advisor. They tend to be straightforward transactions, well-established credits, water and sewer revenues. These appeal to a broad investor mix, meaning that when the underwriters are submitting their bids, they know that it's not a very particular investment fund out there that wants to stay into debt. These are going to be bonds that they can sell to everybody, from Main Street to Wall Street. All types of investors and funds are interested in the type of bond. The risk with the competitive underwriting is you need a stable bond market. You need to go into the market. You pick a day, you go into the market, and this is also the risk with the competitive underwriting. You pick the worst day in the market, the financial markets are collapsing, you find horrible rates, and ultimately the interest rates will be determined by the lowest underwriters. The upside to doing a competitive sale is that you go out there and you sit your bid out. You have all the underwriters come in at the time of bid. You end up, they've done studies, you get a slightly lower interest rate doing a competitive bid, even though every banker will tell you that's not true, just deal with them. When you have bankers bid against each other, you're going to get a lower bid. The risk, as I mentioned, is you pick the wrong day to go into the market, or your transaction and your financial advisor wasn't quite as good as you hoped, and the investors aren't interested in what you're selling. So there is even though you will save a little bit of money, there is a large downside there, or you potentially save money. The negotiated underwriting is much more common. You pick an investment bank out there, and these are the big investment banks that you know. You work with them through the entire process, and it also provides other advantages. They're going to time the market to your advantage. If something goes horribly wrong, they're going to wait until a better time to go to the market. You haven't put all your eggs in a basket when you went to the market. If you're doing something a little uncommon or a different type of project that requires some explanation to the investors, then it's good that you have your underwriters in place. If you're new to the market, if you're a county that's never borrowed money before in the public markets, the underwriters will work with you to help you make your sale. If it's a type of project that only a certain type of group of investors are interested in, then this is the preferred method. And as I mentioned, if you have a volatile bond market. And it allows you flexibility if you go this route. And how underwriters get paid. Basically, these are old numbers. Obviously, interest rates have come down a little bit, but we've taken very, very small numbers here. If the county owes $5,000 at 6% interest, sometimes they'll sell bonds to an underwriter at a discount. And for this, the underwriter, let's say, only pays for 99% of the face amount. So they pay, $4,950 on the $5,000 here. The underwriter turns around, and this is a very simplistic exercise. There's many different ways it can be structured, but the underwriter sells the bond for the 100% of the face amount. So the underwriter or the investment bank makes its profit there. And then the county, of course, true interest cost is both the interest rate plus that discount. Going a little bit back to the process and the authority. As I mentioned, the staff or yourself, the county identifies a financing need or an opportunity. This could be a new money project or a refunding. The staff or finance committee typically presents this proposal to the Board of County Commissioners, you guys, for authorization. It may also include the hiring of various professionals, bond lawyers such as yourself, the underwriters or investment banks involved, the financial advisor. As I mentioned, you approve your proposal and your team. Then you'll adopt your bond authorizing resolution, approve your official statement if you decide to go to the public markets and use an offering document, and pick your method of sale, the negotiated sale or the competitive sale. Then, as I mentioned, you move through the bond sale pricing, the award of the sale, and the closing, or when you actually receive the money from the investment bank and your bonds go into a vault and obligate you to make your repayments. In this process, a lot of times you'll hear validations. Some of y'all may be very familiar with those, some not. Validations is a process that we do a lot, and it depends a little bit on the type of project involved. It basically settles, a validation will settle questions of law and fact, and it will stop future people. You go through a process in front of a judge in a validation and get the judge's seal of approval, and if he gives it to you, after a 30-day appeal period, if no one appeals, you'll have a certificate of no appeal. And basically, it stops future people from challenging a few different things. One is that the purpose of the borrowing is legal. The judge will basically state that the purpose for borrowing the bonds is legal, that you had the authority to issue the bonds, and then certain determinations. If you were to do a tax increment financing that we talked about earlier, that Jennifer mentioned, and you are trying to make a determination of blight, which is the first step in that process, you then go to the court and you get them to validate that, and then it means no one later can come back and challenge that blight. And that doesn't sound like a big deal, but you know, in downtown Tampa, we have a couple of tax increment financings that used to be a bunch of old warehouses and rundown areas, and now have hockey arenas and just beautiful condos and have taken off. If you look at it now, you may think, how is this a tax increment financing district? Look at this place. But you know, it's been there for 25 years, 30 years. And if you lived there when we grew up, or when I grew up, it was a totally different picture and you understood it. But that validation of that declaration of blight protects you, so that citizens can't later challenge the appropriation of that tax increment revenues towards the project. That validation is also real helpful in if you're putting together a sewer system and the requirement that owners of septic tanks connect to a central sewer. That's another example where you go through the validation process. If you're going to extend sewer lines outside of your municipal boundaries, and if you're putting assessments for educational facilities. Basically, you know, as I've practiced, my rule of thumb is when in doubt, validate. Unless someone comes up with a let's not validate and gives you a great reason why. And a lot of times that may be such as a refunding. You're just refinancing previous bonds that were validated, no need to validate. But for new projects, it's typically the way to go. Since we're on camera, I'm going to tell you that the Securities and Exchange Commission and the IRS are great governmental bodies. And I think the world of them and the people that work there. But if the camera were to turn off for a second, I would tell you as issuers of debt that these are the boogeymen. These are the guys that you need to worry about, and not because they're bad, but because they do serve a very valuable and important purpose. What you want them to do is when they're looking at you, to come to the conclusion that you've done everything correctly and that they happily move along to the next person. What you don't want to do is be the one name that everyone talks about. Right now, everybody's talking about the city of Allen Park, Michigan. In the past, it was the city of San Diego. The city of Miami it frequently gets its name involved with the Securities and Exchange Commission and is involved with them now. And why you care is because this can affect you as well. And 10, 12 years ago in the city of San Diego, public officials end up getting fined personally out of their own money in connection with bond offerings. Right now, we're finding officials in City of Allen Park a new novel theory by the Securities Exchange Commission, called control person liability, that even if you don't sign the documents, you can still be liable. Now, the key here is that, A, you can only do so much as a public official. You educate yourself, do as much about the project and why you're borrowing money as possible. Make sure you're hiring good, reputable people that can help you with the process. And you need to understand why these two organizations will come after you. The Securities Exchange Commission, it's when you're selling bonds or any type of loan for that matter, it's a simple statement. If you're making a material misstatement to borrow the money, or you're making a material omission to borrow the money, you've committed securities fraud. And even though the Securities Exchange Commission has very limited authority over county governments, there are a whole host of things they can't go after you for. Securities fraud is one they can. It's Rule 10b-5 and Rule 17a of the Securities Acts. And what is material? That's a facts and circumstances test. You kind of know it. It's what would cause somebody that was going to buy your bonds or buy your loan or lend you money, that they wouldn't lend you the money at the same terms if they knew that. You know, I think deep down we all know when we're making a material misstatement or a material omission. The IRS is slightly different in that it's not a question of necessarily disclosure, which the Securities and Exchange Commission is focused on. The IRS is wondering what you're doing with the money. And again, that you are using the money for what you said you were going to use it for, and that you're not using it for other purposes, either to arbitrage the money and earn interest at a higher rate, or you're using it to fund new projects that are for private companies. And you can in certain circumstances, but it's very, very detailed. Even though we're public finance lawyers, there's actually a subset of specialists that do what we do that focus just on the Internal Revenue Code and the taxes and so forth. A couple of things dealing with either of these organizations. If you should ever find yourself getting contacted by them, is that you know, they have a role to provide, and when they call, the answer isn't to just start talking to them. You hire your lawyers, you get them involved to deal with them, and realize that they're out there to serve a public purpose. They're not out there to get you, even though, you know, some of us might call them the boogeyman. But there's also a process if you've screwed up to fix it. In fact, with the IRS, they have a really neat process they call the VCAP, and again, another, you know, us using a shortened version for the voluntary closing protection agreement that they have, that allows you to go to them and say, whoops, we used some of our bond money for a project we shouldn't have. You know, we accidentally sold some of the property that the bonds financed. It wasn't material to the project, but we couldn't do that because that land was actually financed or acquired through bond proceeds. And instead of, if you go through the IRS process and take your problem to them, rather than them declaring your entire bonds being taxable and causing a major lawsuit with your bondholders, you can turn around and work out a deal to purify the deal. And by working with them, you pay just a percentage of how you've ruined the tax election. So, you know, our point in bringing these up is to just identify to you that these are out there, and that as much as, you know, when you get into the finance world and issuing debt, that you realize that you can't just rely on your professionals. You really need to know what's going on. And if you ever have any questions, there's a bunch of bond documents involved, and the answers are ultimately always in the documents. There's, as Jennifer talked about, the indenture, the trust indenture or the resolution. Sometimes it's done in indenture in a very, very long form, 100-page resolution thrown in front of your county, which will explain all the borrowing terms that are relevant to that part of the transaction. There's documents telling you how you should use the proceeds. And of course, if you went to the public markets and you made a lot of disclosures, that document should be factual with regard to the disclosures that it makes. I think that's about it. I want to make sure we got you out of here on time or a little bit early. I don't know if we have any questions out there. Anybody want to brag about winning the game that we...